2013. We weren't supposed to see the taper tantrum, are we?
That's right. I mean, you mentioned it pretty well. April was a tough month for emerging markets on a combination of external and domestic factors. We saw externally that the dollar appreciated vis-a-vis most world currencies, and on top of that, we saw a pretty sharp increase in U.S. Treasury rates, and this was compounded by some domestic challenges. If you think of Russia, increased sanctions risk. If you think of Turkey, the call for early elections by Erdogan. Argentina, where the central bank's credibility had been undermined in recent weeks, and even Brazil, with high-frequency economic indicators rolling over and increased political uncertainty. That said, looking ahead, we don't think this is a 2013 type of scenario. Emerging markets are a lot more externally resilient than they used to be, and we think this will support the asset class moving forward.
Well, explain that, because that's what we've heard. They're more, as you say, externally resilient. They have a bigger middle class. They're not as dependent on commodities. We've heard that again and again. So why isn't that stabilizing things right now? Why is there so much movement short term when you say longer term there won't be?
We think eventually it will stabilize, and when we mention external resilience, we're thinking about indicators such as current account positions, much improved from 2013 levels, or real interest rates, a lot higher than they used to be, or foreign exchange coverage ratios. All these factors taken together are looking a lot better than in the 2013 taper tantrum.